As of April 1, 2025, Donald Trump is once again President of the United States. And on April 2nd, his sweeping new tariffs officially took effect. Markets are tense. Trade partners are scrambling. But one sector is already feeling the heat: insurance. In this video, we break down how Trump's tariffs are reshaping insurance across the US and the world, with impacts on premiums, investments, and global risk. Stay with us to understand how your own insurance costs might rise, what insurers are doing to protect their portfolios, and how reinsurers around the globe are adjusting to this fast-changing economic landscape. Let's start with American consumers. Will these tariffs make insurance more expensive? Early indicators suggest yes, especially for auto and home insurance. Here's why. Auto insurance. A 25% tariff on imported vehicles and auto parts means repairs cost more. This includes everything from brake pads to bumpers. Steel and aluminum prices are also rising. That means higher costs for insurers when paying out claims. Parts managers and mechanics are reporting daily price increases. One parts manager in Texas said, "We're changing price tags every few hours on imported components." More expensive repairs equals higher claims equals rising premiums. Premiums were already up 12% in 2024. Analysts now expect another jump in 2025. The total added cost to U.S. auto insurance? Over $11 billion. Home insurance. Tariffs on building materials like lumber, drywall, appliances mean rebuilding after a fire or storm now costs more. Insurify estimates tariffs could increase the average homeowner's premium by $106 per year, with rates growing 38% faster than expected. That's a big jump for middle-class households already squeezed by inflation. Health insurance. While hospitals rely on imported drugs and equipment, new tariffs on these supplies could raise costs by up to 15% in the next 6 months. Medical group practices are reporting that they're facing tough decisions: either absorb the cost or pass it along. For now, insurers are watching closely. Group health plans won't adjust overnight, but rising costs could eventually mean higher premiums. In short, every line of insurance, auto, home, health, faces inflationary pressure. And it all started with tariffs. Insurers don't just collect premiums, they invest trillions of dollars in stocks and bonds. These investments are key to their profitability. After the tariffs, U.S. stocks fell sharply. Surprisingly, Treasury bonds also dropped, pushing yields up. This double hit to equities and bonds made April one of the most volatile months in recent insurance market history. This combo hurt insurers' portfolios. But there's some good news. Most insurers hold conservative investments. Around 95% of bond portfolios are investment grade. Analysts say their capital positions are strong. That means they can weather short-term losses, especially if interest income improves. Higher yields mean future bond purchases will generate more income. That's positive. But in the short term, portfolio values have dropped, and that affects reported earnings and capital reserves. Reinsurers and life insurers are especially vulnerable. If defaults increase or if bond downgrades happen in a slowing economy, those losses could become real. Still, most insurers are managing risk carefully, adjusting their asset allocations and looking for stability in sectors less exposed to trade shocks. Globally, insurers in Europe and Asia are responding in real time. Europe. The EU announced retaliatory tariffs within days. That created uncertainty in markets, and European insurers saw share price dips. Trade credit and marine insurers are particularly exposed to disrupted trade flows. Reinsurers like Munich Re and Swiss Re are adjusting risk models, anticipating inflation in claims and changes in global demand. Many are raising prices in higher risk sectors, particularly in industrial and logistics lines. Asia. China retaliated with its own tariffs, especially on U.S. goods. That slowed exports and added pressure to supply chains. Japanese and South Korean insurers are exposed through their manufacturing clients and U.S.-based operations. Japan's largest insurers, Tokyo Marine, Sompo, and MS-AD, have all issued market updates expressing concern over asset volatility and trade credit risk. In South Korea, the government is offering emergency funding to companies most affected by U.S. tariffs, indirectly protecting insurers from a potential wave of defaults. The global insurance system is connected. When the U.S. makes a move, insurers everywhere adjust. From policy pricing to capital reserves, this tariff wave has changed the game. In just 3 weeks, Trump's tariffs have already reshaped the insurance landscape. Premiums are climbing while portfolios are under pressure. Reinsurers are repricing risk. The full effects will take months to play out. But one thing is clear: in today's economy, global trade policy is not just about manufacturers and consumers, it's about how we insure everything from cars to cargo ships. If you found this helpful, give us a thumbs up and subscribe for more analysis on how global trends are reshaping insurance.